From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for April 15th, 2022. It's also tax weekend. Whoopee. Hey, your Milwaukee Bucks start defending their NBA championship this weekend with the Bulls at the Forum. And also this weekend, the Brewers welcome the St. Louis Cardinals to AmFam Field. We've talked a lot about inflation recently. Here's an interesting story, if you're in the baby eel business, or if you just like eating them. In the state of Maine, pre-pandemic, baby eels sold for $525 a pound. Now add in the Russian invasion of Ukraine and COVID-19, and your price for baby eels is now a crazy $2,100 a pound. You can spare yourself those inflated prices by just not eating those slimy little suckers. From the people that brought you Godzilla, Japanese engineers have developed a robot that can peel a banana. It can do it without smashing most of the fruit, and is successful only about half the time. I'm guessing those engineers are making a lot of banana bread. There's a new restaurant in Tokyo that has a couple of special requirements. One is that you're naked except for the paper underwear they give you. The visual that's now stuck in my head is a restaurant full of sumo wrestlers. Since the late 60s, photographer Charles Daniels, not to be confused with musician Charlie Daniels, has been photographing famous rockers like Rod Stewart, Jimi Hendrix, The Who, Grateful Dead, Pink Floyd, Chicago, Fleetwood Mac, and a whole lot more. However, tens of thousands of his photos have never been seen because they're sitting in roughly 3,200 rolls of undeveloped film. Wow. And we have a new definition for procrastination. And finally, China's securities regulator launched a crackdown on brokerage houses that use feng shui to predict stock market trends. So forget all the study, all the research, and all the hard work your broker does for you. It turns out it just depends on where you place the houseplants. On the podcast today, we have Brian Kill, Dave Sandstrom, Chris Evers, Joel Driesing, and wrapping up the week, here's Kyle Tedding.
Well, thanks, Max. We have robots that can do surgery, but apparently peeling a banana is the step too far. Well, bit of a surgical knife to markets this week. The Nasdaq down 2.6%, the S&P 500 down 2.1%. The Dow Jones down 0.8%, closed today at 34,451. For the year, the Nasdaq now down 14.5%, the S&P down 7.5%, and the Dow Jones Industrial Average down 4.7%. Big jump in the benchmark 10-year Treasury yield this week. Closed the week at 2.83 after starting at 2.71. And another big jump in oil prices as the price of a barrel of oil continues to bounce around with news going on around the world. You know, Brian, I think as we look at another week in the books here, granted, Thursday with markets closed on Friday, we've got plenty more news to come out, but it just feels like there's nothing new really coming out anymore. It's just updates on more of what we already know. We hit earnings season, but not a lot of changes there. And so I think, as investors look at their portfolios right now, as we really talk about what's going on in the world, it's more about understanding what those things we already knew and less about new pieces of information coming at us.
Yeah, Kyle, I mean, there's some general themes that, we get to talk about weekly, as a matter of course, and they haven't changed a lot over the last few months. I do think the degree to which we feel certain ways about certain, bits and pieces from that story change, for instance, I think this week, if interest rates haven't gotten your attention, we're the 10 years over 2.8, that's a what do we start the year, 1.4 something, and I think, you will take those moments on any given week and kind of lock into something that captures your attention or whatever. So for me, I guess this week it was, man, I tell you, interest rates, if you've looked at your bond portfolio, you'll see, some pain and suffering as a result of that. But I think there's just more reinforcement of, a handful of themes that we've been talking about for months and years now. Really nothing so new. But the market's starting to react to it. So I think from here, there's going to be some volatility. I don't know that we're going to have a firm direction one way or another, but I think some of these stories are going to play out in the coming weeks and months, and we're going to have a pretty good idea pretty soon where this thing's headed.
And Dave, we saw it in the Nasdaq this week, right? The big sell-off down more than 2.5%, and some of those more growth-heavy technology stocks, I think, reflective of what's going on in interest rates.
Absolutely, and this is kind of a theme that we've been talking about for quite a while now, and how really susceptible those growth names are to rising rates, right? I mean, you have to look for, when you buy those growth stocks, you're paying a premium for those future earnings, and common valuation technique is to discount those earnings back to present value using an interest rate, commonly the 10-year Treasury note. And when you see it going up as fast as it has this year, you're taking quite a haircut on those prices. And I think to Brian's point, it almost didn't appear to be received quite that way at the beginning of the year, but now it does seem to be sinking in, I think, to investors. And as you can see just from the year-to-date numbers, comparing the Nasdaq to the Dow Jones Industrial Average, about a 10% difference. So yeah, growth stocks are taking it on the chin.
Kyle, you mentioned earnings season. I mean, look at the earnings situation itself. We've had record margins for some period of time now, and if you made things in your life, it's material, labor, and overhead. It seems to me like materials costs are going up, labor costs are going up, and certainly many components of overhead are going up. So I think the earnings story in the next couple quarters it's always key, but I think there's going to be a lot of reading the tea leaves in earnings in the next few quarters, and that will be a very telling story as well.
Well, I think critical to look at the quality of businesses that are out there, look at their pricing power that they have within their markets, and understand that, if a lot of S&P earnings the last few years have come from those very high margins, and in particular because a larger portion of the S&P is high-margin growth businesses. It's not your traditional manufacturers that have high input costs. It's businesses where if they sell one more unit, there really isn't all that much more cost to doing that. Because it's a piece of software or it's something that's a little bit easier to scale. And so I think, you look at the labor cost in particular as something that could eat into that. But the reverse of that is if these are businesses that have wide moats, we use the term moat kind of to talk about how defensible these businesses are. I think you see some pricing power in those businesses. You see some cost passed along to end consumers. And so, yeah, there's some pain for the end consumers there, but there's also some protection for some earnings. And so I think it's going to matter, again, the businesses we buy. For such a long time, the growth stocks all rose together, the value stocks all rose together. And I think as you look at the outlook for an environment in which pricing power all of a sudden matters, the kinds of businesses that you're purchasing actually matter as well. And so I think, as we look at some of the mutual funds that we look at on a regular basis, you're starting to see, more quality go into that. You're starting to see businesses that maybe have a little more power over what, they're actually charging their end consumers. I think as we look at some of the economic data this week, Joel, more of the same, in particular consumer prices, producer prices, making their way into the conversation again this week.
Yeah, Kyle, we had the numbers on the consumer price index this week. And so for 5 months in a row now, it's been at 40-year highs. So, that's not a short-term thing anymore if you've got 5 consistent months like that. And we had it again. The inflation rate year to year was 8.5%. And that was the highest since December of 1981 when Dallas was the number one TV show. And the number one hit single was Olivia Newton-John singing Physical. So put that...
Just a few years.
Put that song in
Joel
your
had
head
that
a
poster
little
on
bit.
as well,
Yeah.
I think. Yeah.
But and I say that just because that's been a long time since we've been that high. But again, we keep hearing the news. It's gas prices. It's the gasoline price went up 18% from February to March, and it accounted for more than half of that month's rise in the CPI. Year to year, it was up 48%. And the good news is, because there's good news in this, is that more economists are starting to think that inflation rate is maybe has peaked in March. AAA reported that gas prices have gone down about 5% from where they were in March. But you and I were talking about this before. Gasoline in particular is a very important price because, name another price that's all over the street, that everywhere you're driving, people know the price of gasoline. Whether you're even riding the bus and you don't have a car, you know how steep those prices are.
Yeah, I think that's always been the thing that struck me. For most consumers, the only time they think about the price of a pound of beef or the price of a carton of milk is when they're actually in the store making those purchases. But you are inundated with price data on gasoline if you even leave your house. And so, I think most people can't go more than a quarter mile or so without driving past a gas station, seeing those prices posted. And so from a consumer's mind or from a kind of outlook on, where we are, I think gasoline prices are one of the key pieces to understanding, okay, this is the piece that I see every day that tells me really how bad inflation is. And yet, we got data on consumer sentiment and things are a little better than what we might have otherwise thought.
Right. Yeah. The New York Fed does a survey of consumers, and they found that the long-term expectations for inflation are actually going down. They've gone down from where they were last month. And then we had a consumer sentiment index from the University of Michigan today, and one of the things there is because of a sense that gas prices might have peaked. People are thinking that inflation isn't as big of a deal, although it's still a big deal, but maybe not as big as they thought a month ago. And the other good news that was in that CPI report on Tuesday was that if you strip out the real volatile prices of things like food and energy, the core CPI as they look at it, that actually went down for the second month in a row. And it is at the lowest rate now. The monthly change was at the lowest rate since September. So, it's hard to take that out of a month's of worth of data, but, maybe that's a sign that that inflation has peaked and it's going to be high, but not as high as we were looking at.
The cautionary point, and not to be the negative guy in the room here, but the cautionary thing I would say about inflation is if you take food and energy out and it was up 6.5% last year, which I think what core was, the rate of inflation might go down, but we're not getting that back. That 6.5% is baked into the cake, and I think the labor situation's great and people are getting raises, but they didn't get 6.5% raises. So there's still some pain and suffering, and that consumers are falling a little bit farther behind. And again, not to say that the situation isn't improving or there's light at the end of the tunnel, but let's not forget that what's happened in the past couple of years we're not getting that back. We might get it back on gas, by the way, but a lot of those core consumer goods are going to be priced that much or more from here on out. So,
and Brian, to your point there, the consumer has been amazingly resilient through this process. I mean, you're talking about, to Joel's point, we get a 40-year high inflation rate, and the American consumer is basically saying, hey, we survived the pandemic, $4 gas isn't going to stop me now. And they just keep spending. I mean,
part of that's because the government wrote them $2 trillion worth of checks.
Exactly,
so
right. Cash in the system and their balance sheets are in great shape. But it's also a lot of it is, hey, we canceled our last 2 summer vacations. I'm not canceling this one because of high gas prices. Now, I think your point, Brian, is that's not going to be able to last forever, right? I mean, consumers are eventually, if prices stay elevated, they'll capitulate at some point.
Dave, to your
it
point,
can turn quickly.
Yeah, and to your point, so I put a couple of graphics with our show notes for the podcast every week, and one of the charts that I did was on retail spending, and that's a pretty volatile number month to month anyway. Boy, but you should look at it since February of 2020. It's just all over the place, but it's up. Retail spending is up 20%. From where it left off in February of 2020. So it's really gone up there. And I think you've made this point on this podcast before. A lot of that spending has been in goods, because we weren't able to go out and do the things that we were doing. 2 signs from the retail spending numbers is that we're still seeing bar and restaurant spending going up. And that's a good sign. That's a good sign of consumer confidence.
There's certainly, and Dave, we were talking about this earlier before the podcast, is you're certainly seeing this rotation that we've talked about really for a few months of anticipating it occur, the rotation from high levels of goods spending to rotating over to services spending. So in this CPI report, the inflation rate for services spending was actually higher than the inflation rate for durable goods for the first time in over a year. That's telling me that consumers are rotating their purchases away from, those large durable goods and towards, hey, I haven't been able to go on vacation for a while. I'm going to go do that. I'm going to rent a car. I'm going to fly. I'm going to, book a hotel room now that I feel more comfortable from a pandemic situation. You've definitely seen that rotation, to that point. We saw used car prices go down about 3.5% in the month of March, which was, again, it's a really volatile indicator because used car prices have gone up substantially over the last year, but that's the biggest drop month to month since 1969. So we are seeing that transition from goods spending to services spending. It'll be interesting to look down that supply chain of how does that impact things in terms of demand for fuel, demand for trucking costs, if we're less, required on shipping physical goods to people.
Chris, I know you like to watch the consumer credit card debt too. That story tells a lot this week too, right?
Yeah, I mean, that was last week's numbers on credit card kind of showed, we've talked about how much money consumers saved over the last 2 years because of, the stimulus payments or, people just didn't spend money on a lot of things. So we saw savings rates for consumers jump to record high levels. And since, in the last few months, consumer saving rates have now gone down below what they were before the pandemic. And we've seen credit card spending go up. So what that tells me is some of this excess savings that consumers have built up over the last 2 years, they've burnt it through. They're going to get back to a more steady state level of spending, which indicates two things. One, maybe there's a little bit of a slowdown in consumer spending. That might not be the worst thing in the world. But number two, that could help on the inflation front of less consumers essentially tripping over themselves to go spend this extra money that they had in their bank account.
Well, and I think there's an inflationary expectation that feeds into that YOLO consumption, right? That you only live once, and if prices are going to be higher later, we might as well spend it now because we're going to get more for our dollar than what we'll get down the road. And so, we talk about inflationary expectations being a self-fulfilling prophecy, and I think in some ways that may be what we're seeing. You add in, I think, a number of individuals that believe that the pandemic's over, and really what you now have is people that are just more willing to spend than they have been in a long time because they're concerned the prices are going to be higher to do the same things later on. And they've been saving up for a while, whether it's their own money or whether it's government money or whatever it is. But they're ready to get out there. And so, I think we talk so often about the return benefits of consumer spending and all these different pieces that, go into the economic indicators. And I think most of us sitting around this table are wired a little differently in that we always look at risk first, right? That if it's not worth the risk, we're not going to take it in order to get a little bit of return. And I think there's a lot of risks out there that are quite obvious. You talk about inflation, you talk about Ukraine. I think there's some that are a little bit less obvious. And I had kind of, as I tend to do week to week, put down my list of things that, okay, here's the risks I'm concerned about right now. It's amazing. Joel, you and I were talking about it before the podcast. The one I didn't write down this week is that COVID is still out there. And so I think, we need to remember that, this is something we continue to live with, that, there are economic consequences to having to shut down, whether it's, having to continue to hurt supply chains. Dave, that's something you point out on a regular basis and mentioned, or whether it's just that you can't maybe spend the way you want. So, I think as we look out, other risks you guys are looking at, other risks you see that, maybe we need to be paying attention to that we're not paying attention to right now?
Well, I mean, let's go not 20,000 feet, let's go 40,000 feet. The one thing I keep saying is, you go back 25, 30 years, interest rates have been going down. And if you especially focus on the post-financial crisis world, the supply of money has grown substantially. So you had record low interest rates and you had a lot of debt and a substantial amount of money out there. And you're kind of like, well, certainly I think we'd all agree that at least some of that led to some inflationary prices in most every asset we know, right? Real estate, used cars, and some of it's supply chain stuff and some of it's labor and some of it's all this other stuff. But certainly some of it is there's a lot of money in the system, a lot of easy money. we've hit an inflection point there, right? We're going the other way. The Fed's going to try and trim its balance sheet. Interest rates are on the rise, and that money will come out of the system. Because we've never done some of this before to get the money in, we don't really know how it's going to come out because we've never done it on the way out before. So I think, just really in big, long, cyclical, kind of, big picture stuff, that's something I think we ought to keep our eyes on because it could be just fine, but we don't know, and I think we won't know until we see how things kind of settle back to normal, whatever that is. So.
Yeah, I'll just tack on, I keep thinking about the labor picture. I've hammered on this a few times in the podcast in the past, but the labor market is very strong in terms of level of participation returning, and frankly, unemployment rates extremely low. But we just frankly don't have enough laborers in this country. That we're going to have to eventually find a way of either doing more with technology or finding a way of increasing the labor pool. As we talk a lot about, one of the lessons of the last 2 years was the risks of just-in-time supply chains and, not having very well diversified supply chains. If that lesson learned means that our answer to that is onshoring more manufacturing here in the States, we're going to have to find a way of coming up with more laborers in this country. And maybe that's a great opportunity, but it's something that needs to be, looked at as we kind of go forward into the next few years as well.
And Chris, remember the big part in all of that is demographics. There's just so much you can do with the number of bodies that are available, So
Chris, you need to have like 10 kids, right?
Well,
yeah, we're all
wait
looking at
18
you.
years then.
I think what happens, though, going forward, and this is obviously down the road a ways, but that's going to force productivity back into the equation. And you're going to start to see, manufacturing and any actually service industries as well looking for ways to automate and deal with that lack of. Just anecdotally, I just talked to somebody who was saying that they ran into a situation where now they're offshoring drive-through services. So when you go to the drive-through to McDonald's, you're not talking to somebody that's actually in that restaurant. So you can imagine how bad the service is. just wait till you try to get a second set of fries or a pack of fries, right?
App ordering is going to be all the more important, I think, when we get to that point. I think, though, Dave, that's kind of the key is that there are paths forward. As much as some of these risks, I think, are real, they have the potential to take markets down temporarily. I think the right way to be thinking about this as an investor is that there are always those short-term risks out there. That longer term, the reason why you're an investor is because you're looking for those kinds of opportunities. Even here internally, we're constantly looking for ways to improve our services. And so, we've got new relationship management software that we roll out. We've got the ability to do electronic signature that we roll out. Those are all things I think that take, incremental improvements, right? That, make life a little easier for everyone, maybe make the time to do certain tasks a little easier. That makes everybody more profitable.
Kyle, it's just as a people thing. It's a very different problem to have everybody that wants a job have a job and to be able to sustain their lives and their families than it was, go back to the Depression or whatever, where 25% of the population didn't have a job and didn't have something to eat. So even though it's a problem on a relative basis, it's a far better problem to have than so many other things we could be facing. So
appreciate that. Well, thank you, as always, for listening, and we enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.